Today we're exploring a topic that's on everyone's mind, the housing market. Specifically, we'll look at the 18-year property cycle and ask the big question, are we heading for a boom or a crash? A recent report from Rightmove showed property prices fell by 1.2% in July, and they've reduced their annual forecast for price growth to just 2%. This decline is attributed to the end of stamp duty cuts and more homes being on the market than at any point in the last 10 years. This brings us to the key debate. Is the 18-year property cycle a reliable indicator, or have recent unprecedented events finally broken its long-standing pattern? Economist Fred Harrison famously predicted the 1989 and 2008 crashes years in advance using the 18-year property cycle. He believes the next crash will occur in 2027, not 2025. For those unfamiliar with his theory, visit gradragstoriches.co.uk, where we have 6 posts dedicated to this. So, where do we stand now? Pessimists point to 4 key factors. They believe are driving an impending crash: a weak economy with potential job cuts, small landlords, and second homeowners selling up due to rising taxes, a general increase in household costs like council tax and energy bills, and a looming fiscal crisis that could force the Bank of England to hike interest rates. But there are strong counter-arguments to each of these points. Recent wage growth has improved affordability. Private and institutional investors are increasingly purchasing rental properties, which could absorb some supply from small landlords. While household costs are rising, new government support schemes and easier access to mortgages could cushion the impact on demand. Speaking of mortgages, market forecasts suggest 2 interest rate cuts later this year, which would benefit the housing market. Recent years have brought a barrage of challenges that critics argue have fundamentally disrupted the 18-year cycle. The COVID-19 pandemic, ongoing global conflicts, and a period of higher interest rates have all caused significant market volatility. Some critics even argue that, when adjusted for inflation, the average house price hasn't really increased since 2012. On the other hand, a major piece of financial news broke this month. Chancellor Rachel Reeves plans to allow banks to offer mortgages up to 6 times a borrower's salary. For a couple earning a combined £80,000, this could boost their borrowing capacity from £360,000 to £400,000, £180,000. This move raises serious alarm bells. It's not hard to see that lending people more money will likely push house prices higher. However, extending mortgage debt this far also raises the risk of financial overreach for borrowers, potentially contributing to a future crash. So is the 18-year property cycle broken? Despite conflicting signals, Fred Harrison remains confident that the long-term fundamentals remain intact. He believes the market is emerging from a correction phase and entering a recovery, to be followed by a boom. Harrison predicts a significant rise in prices before a major crash around 2027. He views recent dips as a necessary recalibration and expects falling mortgage rates to stimulate further market activity, especially in high-yield areas such as Leeds and Sheffield. This outlook is supported by news like lenders being permitted to offer larger mortgages and substantial investment flowing into the build-to-rent sector, all of which could fuel a potential boom. So, what's your view? Are we on the verge of a new property boom, or is a crash imminent?